Good afternoon, everyone, and welcome to the Global Small Companies Fund webinar update. My name is Damien Crowley, Head of Sales and Marketing at Pengana. Joining me today is Jon Moog and also Ron Chin from Lizard in Chicago. Jon is the Portfolio Manager and CIO, and Ron is the Chief Operating Officer. The format for today's webinar, which is fairly similar to our other webinars, is that Jon's going to speak for around 20 to 25 minutes and go through the slides. And then you'll have the opportunity to ask questions of Jon, and you can send those questions through online throughout the presentation, obviously. I'll now pass over to Jon to take you through the presentation. Thanks, Jon.
Great, thanks a lot, Damien. I appreciate the introduction, and I'm aware most of you have probably already heard our story or listened to me talk at some point. So I will go through the presentation, and I'll try to make my comments around the opportunity set and our process fairly brief, and then get more into the current environment, some of the recent performance, and then some more stock-specific stories. So hopefully that will be helpful for everybody. So as many of you know, starting on slide 2, we think the small cap universe globally offers a very specific and rich opportunity set for investors, and we think it's a opportunity set that cannot be replicated in mid and large caps, largely because of a much more inefficient and orphaned status of the universe. So, I think slide 2 talks a little bit about the small cap universe, and I think the key takeaways here are just that a huge percentage of the small cap universe is uncovered, and there's many fewer analysts covering each individual equity, which gives a much greater opportunity to find names floating under the radar, very high quality businesses at much cheaper prices that are misunderstood. So what we are looking for ultimately is trying to identify misunderstood situations in the marketplace and take advantage of them. And I think the small cap universe offers a very rich opportunity set that way for this structural reason. And I think on slide 3, the other component that gets us really excited globally is how large this universe has become over time. I mean, I think if you go back 20 years, the universe was probably a third of the size it is today in terms of number of listed equities. And the explosion in the number of listed equities over the last 20 years has really come as capital markets have opened up around the world. Even Europe, if you go back to the early 90s, was a fairly closed marketplace. Now Europe has opened up, China's opened up, India's opened up, and you have just a huge number of listed equities, which gives us a great opportunity, again, to invest in all these companies around the world that we think can be misunderstood, are going to create a lot of value over time, and is the opportunity set that we are ideally attacking. To talk a little bit on slide 4 about how we attack the universe and what we do. I don't want to get into too many of the details of the slide here, but I think with Lizard, the important takeaways are, this is a universe that is tough to source ideas and tough to do research in. And at Lizard, we've been doing it for over 10 years now. So you have a team that's been together and has experience in both finding and researching ideas over a long-term time horizon. And so, what we specialize in is attacking this inefficient universe and finding very specific investments that we can put significant capital behind to really drive investment returns over a long period of time. And that's really what our entire process is built around and driven by. And I think it's really, the proof is in our long-term track record, as well as a team that has been doing this for quite a long period of time. On slide 5, we talk a little bit more about specifically what kinds of businesses do we invest in this fund? What are we looking for? I think the first and strongest point here is we're looking for business models that we think not only are sustainable, but will drive high returns on capital for long periods of time. So very high quality businesses. We also want balance sheets that are self-funding through almost any kind of market environment. In small caps specifically, where funding windows and liquidity concerns can develop, we want companies that can fund their growth and can live through tough times, and we think that's a critical component. The third thing we look for is a management team that is well aligned with us and trying to create value for us, and it has shown a track record of allocating capital efficiently over time. And I think the fourth piece, and this is critical when you start moving into markets away from Anglo-Saxon driven jurisdictions, is corporate governance policies that protect minority shareholders. So in certain jurisdictions, we really want a company to have shown compliance to treating minority shareholders in a friendly and fair way, and that's something that's important for us. And then the fifth piece, which is totally out of a company's control, is valuation. We typically want to be investing in a business that we think will generate 20% plus return a year over a 3 to 5 year time horizon. Or if you think about it differently, we want to be paying about half of what we think a business is worth on a 3 to 5 year time horizon. So that's what we're looking for on a micro level with each investment we make. The portfolio overall, what does it tend to look like? We'll talk about this on slide 6 a little bit. The portfolio will typically be between 80 and 100% invested. We will hold cash, and we are holding cash now. We do that as an opportunity for two reasons. The first is we never want to force capital to work when we can't find investments that we think meet our criteria. The second reason we do that is because in times of distress, the small cap universe gets hit the hardest. Liquidity becomes a concern, and we always want to have cash on the side so that we can be a provider of liquidity, and we never want to be a forced seller in that marketplace. So you will see us hold cash and use it opportunistically. What does the portfolio on the equity side actually look like? Typically, you see a range between 30 and 50 names. Position sizes will bounce around between 2 and 5% of the portfolio. And I think as a rule of thumb, the top 10 will typically make up between 30 and 40% of the fund, or 35 and 40% of the fund. Turnover in the vehicle, you should expect our turnover to bounce around from anywhere from 20 to 40%. You know, we typically hold things, our investment horizon is 2 to 5 years or longer for businesses that continue to compound for us. We are very long-term investors, and we will hold positions through periods of volatility. From a sector-focused perspective, we're generalists. There are things we don't do. We tend to stay away from businesses that, one, have bad balance sheets inherently. So banks, for example, we tend to think of as very levered. Remember that balance sheet issue I was talking about? We tend to stay away from banks because we don't understand the balance sheets. We tend to stay away from biotech because we don't fundamentally understand some of the binary outcomes. We tend to stay away from businesses we really can't get our head around, but we do follow a generalist approach. And typically what we will do with sectors as well as the rest of the portfolio from a geographic and a currency perspective is we will look at the portfolio top down to really as a risk, from a risk perspective, and that's how we control risk. So what gets into the portfolio gets in from a bottoms up perspective, and we control risk from a top down perspective. You know, so both on a sector and a geographic basis, you'll see us put limits on the fund in terms of how much any one sector or country can be of the fund. And what you'll always see from us, we do invest in the small cap space. Here we say median market cap will be under 3 billion. I would say the sweet spot for us for the typical equity is about 500 million to 2 billion. It would be a typical market cap that we tend to have where our sweet spot is. Moving on to the current environment on slide 7, and you know, here I'll just give you some thoughts of what things we're seeing, what we're thinking about. I think everyone probably on the phone and a lot of investors in the U.S. and globally are all trying to get their heads around some fairly serious issues right now, as are we. So I'll give you my perspective on what's happening and what has happened. You know, I think the first point is you've seen a large divergence in performance, and this has started to reverse itself a bit in October and into November, but you've really seen the U.S. dramatically outperform the rest of the international, both developed and emerging international markets. And this is a phenomenon we haven't really experienced to this extent in the 10 years we've been operating at Lizard. So what has driven this divergence, and how sustainable is it, and who's right? Is the U.S. performance an indication of everything being fine globally, or just the U.S. being fine globally, or are the international markets indicating something that U.S. investors haven't realized, and how are we thinking about that? I think the first point here that, you know, what you've had in the U.S. and what has driven a significant percentage of the outperformance from our viewpoint has been fiscal policy by the U.S. government. So lower taxes has flooded the market with liquidity, and you've seen asset prices and valuations increase pretty dramatically, and that's been accompanied by very significant and cheap debt levels. So you have a lot of leverage in the U.S. right now. as well as cheap taxes, which have driven valuation multiples up over the last 12 months. So we really haven't seen, and earnings have been strong, but I think more importantly, you've also seen multiples themselves expand pretty dramatically in the U.S. And I think that's something, the disparity in multiples, valuation multiples, whether it be earnings or enterprise value to EBITDA, whatever it might be, between a U.S. name right now and some of their global peers, the contrast is pretty alarming from our perspective. I think the other thing that we have been seeing, and here I talk about increased market volatility due to some prominent macro factors. I think volatility is back in the marketplace, and I think that is a healthy thing. However, I do think there's some very serious things to understand from a macroeconomic standpoint of what's happening right now, and my viewpoint of what the potential ramifications are and what the important things to watch are. The first point here I would make is, if we look at China right now, in our estimation, there is a clear indication that the Chinese economy is slowing, and slowing fairly substantially. We think that is a very important global phenomenon. And why I think this is a much more important global phenomenon than maybe realized right now is if you compare China and the rest of the emerging markets today versus China and the rest of the emerging markets in the 2008 recession or in the 1999-2000 recessionary period, what you will find is that China is now, through compounding, become a very significant global weight in two important areas. One is global GDP growth, and the second is CapEx spending. And both of those are obviously correlated, but China and emerging markets now make up over 40% of total global CapEx. And that it was not true in 2008. And why that's so important is because, the old saying went, if the U.S. caught a cold, had a sneeze, the rest of the world caught a cold. I think the same in some regard can be said about China right now, and I'm not sure that's fully understood. So I think that's really important. And one thing we're spending a lot of time thinking about and watching right now is the Chinese economy, and which we believe is slowing. But the secondary piece is, you saw China start to slow in 2015, and the government reacted very quickly with very significant stimulus, which has carried us through to about today. And now I believe the Chinese government is faced with the decision whether they stimulate again and try to kick the can down the road, or whether they really start to restructure some of the off-balance sheet debt and some of that they have in many of the SOEs and the shadow banking system there. And so from my viewpoint, I think watching what the Chinese government decides to do and how to stimulate or not stimulate and how much to stimulate will be pretty important driver in terms of global GDP and the operating environment for many cyclical companies over the next couple of years. So I think that's something we're very keen on, very aware of. I think the other issue that you have in Europe, quite frankly, that's restraining a lot of valuations is, one, concern about the growth of periphery countries. Obviously, you've seen some of the Italian concerns in their banking system, which we believe are ultimately will get resolved and aren't an overly large issue. And the second is Brexit. I think from a real chaotic situation, if Brexit were to get ugly and the UK didn't find a productive way to leave the Eurozone, you'd have a real issue. I think it's a logical conclusion would be it would be best for all parties to find a solution to Brexit that would be manageable for everyone. However, we think there is a political issue here in terms of the fact that what would be acceptable for Europe in terms of an orderly exit is certainly unacceptable for certain of the right-wing elements of the UK Parliament and those that Theresa May has to deal with. So she's and based on the recent headlines, it seems like there may be a solution in hand, which we think is a great thing. But there is some risk that if that blows up, cooler heads don't prevail, and you have, so we view that as a lower probability event, but it's certainly an event that I think is on investors' minds in both the UK and the rest of Europe. So that's something we're watching as well. But I think, ultimately, from our viewpoint, Europe certainly looks very attractively priced in our point, probably, and part of that is, I think, factoring in some of the concern. And if that were to evaporate, I think actually Europe looks quite cheap right now. And so I think that's the other big macroeconomic concern. And I think the thing you've been seeing the last month or 2 months is the U.S. investors who have been kind of on this tax-fueled high of animal spirits starting to realize that global growth will impact a lot of U.S. multinationals, as well as, and the party is kind of coming to an end there. And you're starting really obviously to see it in the FANG stocks. And the other phenomenon I think you're starting to really see in the U.S. and something that I think people have been talking about for years but really haven't seen is when now that ETFs and passive money have become a much bigger part of the market, what happens when those fund flows reverse and indiscriminate selling really starts to hit and momentum gets behind that indiscriminate selling. And we've seen that in a couple pockets here in the U.S. the last couple months. And so I think that's, when you think about the volatility in the short term in the marketplace, we do think that it will be more significant as you work through these periods, given that the ETF money can come in and out of the market so much faster. The last piece, and I think this gives me, I think it's something I'm fairly optimistic about, is that over the last 10 years, you've really seen value stocks underperform growth stocks. And I think specifically in the U.S., you talk about the FANG stocks, you look at just the valuation multiples there, how much capital's gone into these names. It has been a panacea for investors that we think is coming to an end or may come to an end. And if it does, we think you could have a real rotation in leadership from growth back to value. And that's something where you were thinking about it. I think you will, it's something that at some point reverses itself as you really have a two-tiered market in our view now between very high multiple growth stocks and much cheaper value stocks. And some of these value stocks we're looking at today are really at very, very attractive multiples versus growth stocks with returns on capital and growth that don't justify the valuations. And that's something we're also trying to reconcile. So that's, I think, a little bit about the market backdrop we're operating in. Please send in questions to Damien about that, and I'm happy to address them as you go through, if anything I said percolates interest. Moving on to the fund's performance, the fund has had a rough quarter, and you can see, I think, you can see that slide 8 is our long-term performance. On slide 9, it gives you a little better picture of recent performance. So I want to take a minute to address why, what has happened this quarter, what has caused the underperformance that, I think has been unusual in Lizard's history. So I just want to address that for a minute. And I think there were two, to really break it down simply, there are two major drivers of the underperformance. The first was stock-specific issues. We've had two names in the fund that have been significantly negative performers. That would be AMS and Tateru. AMS has obviously been caught up in the semi-Apple supply chain issues that everyone is probably keenly aware of. It's a name we haven't sold. I believe, the mistake we made was probably being too optimistic. It's a name we bought quite a period of time ago. We made a very big return on it, in 2017. We did not exit the position, and now we're probably back to our cost basis in the name, but it has been very painful. Tateru is another name in Japan where we got caught up in some of the, there has been financing issues in some of the real estate sector in Japan that Tateru is caught up in. It's not something we picked up during our diligence, and I think it would have been very challenging to pick up in, but again, another name that has been a detriment to performance. So I think those two names have been an issue. And then I think the other large factor that has weighed on us has really been, given the valuation disparity, and I think when I was in Australia about a year ago, maybe it was in January of this year, I forget exactly when it was, we had been quite underweight the U.S. for that entire period, really based on just from a bottoms-up perspective where we were finding value. That issue has obviously gotten worse. And so given the underweight U.S. and the U.S. outperforming pretty dramatically this year, that's been another issue for our relative performance. Those have been the two large issues in the June through September time period where most of the performance hit. So I did want to address those. We have not changed our U.S. weighting. And I think at this point, given my earlier comments We believe from a value standpoint, most of the value we are finding is outside the U.S. We have made investments in the U.S. this year, but by and large, we think the valuation discrepancy is something, we are happy to hold through long term. And then maybe let's move on to how our portfolio is positioned on slide 10. And you can see this a little more in pictures. Currently the portfolio is about 33 names. We've reduced some of the names. We've taken some of the names out of the portfolio over the last quarter as we've really combed through the portfolio and tried to make sure we were very confident in all the thesis in all of our investments. So we have 33 names. Top 10 is about 34% of the fund, and we're 81% invested. Talking about regional and sector exposure right now, our regional exposure, again, Europe is our largest weighting at the moment. North America, their second largest weighting, but still well under the benchmark. And then you can see a pretty diverse geographic weighting behind that. From a sector, I just want to make a comment on the sector. I think our consumer discretionary weighting is incorrect. Here, I would say our consumer discretionary based on our sector weightings is about 20% of the fund, and our consumer communication services would be the difference, which is about 15, 16% of the fund. So I just want to say I think our sector exposure is a little more diverse than this chart would indicate. But again, a very diverse set, and I think you'll see us underweight certain sectors over time, and industrials right now, specifically given some of the cyclical concerns we have. So I think it's a fairly normal regional and sector diversity we have in the fund now. You will see that bounce around a little over time, but we'll always have diversity. I'll just touch on some stocks fairly quickly. I'll maybe pick two out to talk about that I haven't talked about before in Australia. The first is one of the larger positions in the fund on slide 12 is a business called Nice Information Services. This is a Korean-based business. It is the largest credit bureau in Korea. If you guys are unfamiliar with the credit bureau business model, maybe some of you invest in the U.S., you're familiar with Experian or some of the others. It is a phenomenal business, and effectively they are a database with very rich data on consumer, probably almost every consumer in Korea who has credit, and so they are the go-to for banks, credit cards, whoever it might be, to go get financial data to see if these banks should make loans to these consumers, whether it be credit card, mortgage, whatever it might be. This is a business that was bought about 5 years ago by a self-made, wealthy Korean gentleman. He has slowly built this business over time with add-on services, and we just love the market position. They dominate. They're really the dominant provider in Korea. We paid about 15 times cash earnings for a business with, very high returns on invested capital that grows at 10 to 15% a year. And I would say a very traditional investment for us. And again, I think what we love about this business is very few people outside of Korea have ever heard of it. There's very little brokerage coverage, but just a very good, very dominant business in Korea and very cash generative, most importantly. The other business I'll take a minute to talk about on slide 14 is TripAdvisor. I think that's a slightly different business in terms of the fact that most people on the phone have probably had some interaction as a consumer with TripAdvisor. As many of you know, it's a great site for hotel reviews, understanding new destinations, hotels, tours, whatever it might be. And I think TripAdvisor is an interesting case for us in that when we made this investment, the reason we invested in TripAdvisor, it has two core businesses. The first business is what we'd call the hotel business. So if you're reviewing a hotel on TripAdvisor, you would either book your hotel rooms from TripAdvisor itself or click through to Priceline and book it on Priceline, and that was a revenue generation model for TripAdvisor. Their second business is what I'll call the non-hotel business. So whether it be a tour or a restaurant or whatever it might be, you want to go visit when you're on vacation, they have a very dominant share of booking those types of activities. And that business is I would say they dominate. They've got very good share. It's growing 20% a year with very high returns. When we made this investment, the hotel business was struggling based on some self-inflicted issues that they have had. They had a bit of a spat with Priceline, as well as making their front-facing consumer proposition a little more unfriendly, which had caused a big revenue and margin hit on the hotel business side. So when we made this investment, we felt like we were basically getting paying for the non-hotel business and getting the hotel business for free. Since we've made the investment, you've seen new management really focus on the hotel business, reduce inefficient marketing spending, fix the relationship with Priceline, and really drive that margin back into the hotel business, and the stock has reacted accordingly. And so I think a very different example, but also a very high quality business. What we liked about TripAdvisor is they just have dominant share of eyeballs in terms of hotel reviews, and in terms of, if you look at the amount of time spent related to travel of any other website, they really lead every website in the world. So I think from that perspective, what we feel like that's what gave us downside protection, but we think another very unique business. So I just wanted to talk about those two names. I'm happy to take questions about anything I've said, as well as any other investment we've made now. I've talked for about my allotted time, and I'm sure Damien's ready to give me the hook. So I'll close it up there and wrap it up there. And I think with closing remarks, just saying, I think overall the environment we're operating in is one that is fraught with some concern, some danger. However, that is exactly the type of environment we've been waiting for, and provides the opportunities to allocate capital and earn very high returns. We have plenty of cash on the sideline and are very excited to deploy it. We are starting to see some very interesting selective opportunities. So on one hand, I think we're quite cautious. On the other hand, we're becoming more optimistic by the day as we see stocks sell off. And so, I think we're very optimistic about the future, and I'll leave it there and turn it over to Q&A.
John, there's no questions that have come through as yet. We're just having a look at the screen here. This is a couple of more points you want to expand on a little bit more, or did you want to talk about some of those other stock stories in the interim?
Sure. Why don't we talk briefly about Nissan on slide 15? So Nissan, I think, is another, is an interesting name that most people probably haven't heard of. And I think it's indicative of the typical investment we will make when I talk about being in an orphaned universe. So Nissan Foods there's a Japanese parent company called Nissan Foods. They took a decision to spin out their Hong Kong and Chinese business to Nissan Foods, which is a Hong Kong listed entity. When they spun out the business and listed it in Hong Kong, they left about 50% of the market cap cash, which was equivalent to about 50% of the market cap on the balance sheet. And what interested to hear was, one, obviously the balance sheet strength, and two, this business itself is a ramen business. So they sell noodles like a Ting Yi or a UPC. They sell ramen noodles in grocery stores. They've got 70% market share in Hong Kong. They've got 20% market share in southern China and are growing in southern China. So it's a business that grows 5 to 10% a year with good returns on capital, but a very stable, good business. And what really compelled us here is we think, this was totally misunderstood IPO, in that when the only analyst who covered the name at the time we made the investment had never looked at the balance sheet and was just focused on the fact that this company was trading at high teens earnings multiples and really wasn't looking at any valuation metrics. However, for us, when we looked at this business, high quality business, good management team, creating value, and when we stripped out the cash, we had a business that was trading at 3 times EBITDA, 5 times earnings, and just under 10 times earnings ex cash. And for us, that's exactly the opportunity set. When someone misunderstands that balance sheet, you have a very good company trading at a very, very cheap multiple. And I think this happens, so this is a business that's about a $500 million US market cap, but that's still 75% owned by the parent. So from a free flow perspective, way too small for most investors to care about, but exactly what we try to care about and find. And we think over time here, there's a big opportunity, not only for the company to create value, but also a very big revaluation as people realize exactly how cheap it is. And
just take a look if the questions come through. Any questions coming through? Yeah, now we've got them. Okay. John, the first question is, what are the major risks facing the market today? Is there a risk of a major correction? It's from Peter Jackson. So I think there, I think
I think the way we have talked, when Leah and I have talked about what's happening recently, we've kind of been calling internally a rolling bear market. You saw it really hit emerging markets first, then you saw it hit Europe, and I think it's interesting to note, but every market in the world, I believe outside the U.S. and maybe some other small market I'm not aware of, is down. Hit their peaks in January and have been declining since. And so, from our perspective, I think we are in a much more negative market environment than people may realize right now. A major market correction, and I guess definitionally, I'm not sure, what constitutes major over what time period, but we do think we're in a more negative environment, certainly, and we have positioned the portfolio not only for that negative environment, but to be opportunistic in it. So we do think there is a risk of a fairly significant correction at some point, I suppose would be the answer. Exactly how big and where, we're not sure, but we do think, back to this bifurcation in the market, and we're very wary of situations that we think are very overvalued, and I think there are two core areas I would just look at there. One is very highly valued stocks. The second are names that have been traditionally cyclical, that have not exhibited any cyclical concerns over a long period of time. And what would a normalized operating profit margin be for those businesses? We think there are a lot of companies that are currently operating at operating margins that profit margins that will likely not be sustainable over a full cycle. So I think those are the two areas at the greatest risk for a big correction, and I think those are two areas we're very actively trying to avoid.
Thanks, John. And another question from Stuart Hudson. It seems that 2019 looms as a corrective year at a minimum. With that background, what will change the growth versus value scenario?
So the question, as I understand it, is if 2019 is a bad year, a correct year, a down year for stocks, why would value outperform growth?
I think what will be the catalyst that tweaks that growth versus value?
Yeah, I think that's always it's hard for us to point to a specific catalyst, I suppose. I do think, when you're talking about a correction and you're talking about let's say any 6-month investment horizon or shorter term investment horizon, typically what would explain large moves are fund flows. And I think when you look at fund flows into ETFs, and ETFs specifically targeting certain growth sectors over the last couple of years, I would imagine if those fund flows reverse, that would hit those names disproportionately. Thanks,
John. Another question coming through. Will Brexit change your sector weighting in Europe?
Will. So if you look at our European exposure, we're about 6% exposed to UK itself. The rest of the exposure is non-UK exposure. If we were to go into I think Brexit is probably going to happen, whether I think it's a hard Brexit or, a soft Brexit, I don't know how you want to think about it, but, I think if there was something that dramatically threatened the Eurozone as a whole, it was that big a deal, yeah, that would cause us to change our weighting in Europe. I think if things go relatively according to plan, I don't foresee us changing our weightings.
Okay. So another question from Guy Freeland. Hi, each of the 3 stocks you have spoken about have traded much higher since the fund invested than the price today. Can you talk about your thinking about when you decide to sell to lock in gains?
Can you repeat the first part of that question?
Each of the 3 stocks you have spoken about have traded much higher since the fund invested than the price today. Can you talk about your sell discipline, I suppose, or when you decide to sell?
Yeah, sure. Why don't I just talk about each of the names individually? Because I think we have had that issue. I'm not sure that these 3 names I would think about is well, maybe not, but in terms of NICE, I think it's traded slightly above where we, but remember, when you're looking at these, we're never going to top tick a stock. So, and especially in our liquid market space, like it would take us, it often takes us weeks or months to exit a position. So when you're looking at a peak or a trough, typically those aren't realistic in terms of buying or selling a stock. So I would say with NICE and TripAdvisor, catching the top or the bottom would have been quite challenging. But, you know, I think Nissen is in a liquid situation where we believe we'll hold it for quite a period of time. Over time, how we decided to sell stocks, we look at our IRRs or our return that we expect over a 3 to 5 year time horizon every month. And as IRRs start to get to mid-single digits, we typically exit a position. But I think if you look at AMS, that's a name where I believe we made a mistake by not exiting. And so I think, you know, our process there is to exit positions as we believe they approach fair value. And if we get fair value wrong, that's when we'll get selling wrong. And I think we got it wrong on AMS, for an example. So that's something we're always focused on. We're always trying to improve our process, but that's effectively how we do it.
John, perhaps we got one final question here, it looks like. Are you starting to find more value in stocks now with things getting cheaper?
Yeah, certainly. I mean, I think yes, absolutely. You know, I think we're seeing some names with, you know, return profiles and even businesses that are growing at a decent clip with high returns, trading at multiples we haven't seen in a while. And I wouldn't say that's, you know, you can just buy markets blindly, but certain names are certainly getting dislocated to a point that they're very, very attractive, yes.
Thanks, John. We haven't got any more questions coming through, so we might leave it there. And thank you, everyone, for joining us today and taking the time. Over the next week, we'll send you an email with today's presentation and a link to the recording of the webinar, which will also be on the website. So thank you again. Thanks to John, and have a nice day, everyone.
Thank you for listening.